this is MrChris. Everyone on YouTube seems to be trashing ULTY. And I get why. The fund's net asset value collapsed so fast that scared off a lot of people. But here's the thing. The ULTY we have today is not the same ULTY we had a year ago, and that makes all the difference. In this video, I will share with you my perspective as to why many get ULTY wrong. You see, the ULTY of the past is not the ULTY of today and tomorrow. The phrase past performance does not guarantee future performance. Cuts both ways. Good performance in the past does not mean good performance today and in the future, and similarly, bad performance in the past does not mean bad performance today and in the future. Let's be real. Before March 2025, ULTY's net asset value was eroding at about $1.10 a month. In just 1 year, it went from around $20 a share down to $6. And that is brutal. And that is why so many creators call it a losing fund. But the mistake a lot of people are making is this. They keep judging ULTY by its old playbook. And that's not the whole story anymore. Since March 2025, ULTY's price has been holding steady in the $5.50 to $6 range. And it's not by accident. The fund made a huge change in March 2025, and I will argue that it is basically a new company now. Here's what happened. Before March 2025, ULTY was stuck with just covered calls and synthetic strategies. That setup worked when markets were calm, but when volatility spiked, it chewed through net asset value like crazy. So after March, they expanded their strategy. Now ULTY can use covered calls, callers, credit spreads, and at the same time, they now own the stocks that they use for trading covered call options. And that is a game changer because callers and credit spreads give them tools to manage downside risk and protect net asset value while still collecting premium income. It's like moving from a bicycle to a car. Same idea of transportation, but a whole new capability. Now here's why I stuck with it. I trade options on my own using the no-loss method of the wheel strategy, and I initially used ULTY's holdings as a model portfolio. I was successful in trading options, making more than $100,000 in 2024, and now in 2025, I am at $210,000 of earned premium. So yes, I believe ULTY, except that pre-March 2025, ULTY, that strategy is now working. Pre-2025, the strategy is just bad. In order to be profitable in ULTY, I have to minimize my ULTY holdings net asset value erosion by keeping my cost close to ULTY's market price. I kept my cost basis close to ULTY's market price by dripping dividends and reallocating from weaker funds back into ULTY. And because of that, my total return is now over $125,000, and I'm getting about $25,000 of dividend a month from ULTY alone. So when people say ULTY is a disaster, I look at my numbers and I see a very different picture. If you're a new investor, don't get too hung up on ULTY's pre-March history. That was the old strategy. What matters now is how it's performing with this new approach. Do not make your decision based on the cost basis of those who got into ULTY in March 2024. Make your decision based on the recent performance of ULTY. This is what the other YouTubers don't tell you. They keep on saying net asset value erosion without regards to your own cost basis. Make a decision based on your own portfolio and the time that you purchased ULTY. Consider someone who purchased 10,000 shares of ULTY in March 2024. And for illustration purposes, let us say that his cost is $20 per share. His total cost then is $200,000 and keeps the income as cash, no drip. The total dividends that he would have received is $141,190. At the current price of $5.67 per share, his current net asset value for the 10,000 shares is $56,700. And his total return is equal to $141,190 plus $56,700 minus the cost of $200,000, and he has actually a loss. His total return is a loss of $2,110. But he is on his way to breaking even. Now compare this with someone who purchased 10,000 shares of ULTY in March 2025. And for illustration purposes, let's say that his cost is $6 per share for a total cost of $60,000. The total dividend that this guy would have received now stands at $26,000. With the current price of $5.67 per share, his current net asset value is $56,700, and therefore his total return is equal to $56,700 plus $26,000 minus the $60,000 cost, and his total return is equal to $22,700. This is why I'm saying that the phrase past performance does not guarantee future performance cuts both ways. ULTY's bad performance does not mean that its future performance will be bad, especially when ULTY is now a different company from the perspective that its strategy to generate dividend income has drastically changed. Remember that ULTY is an income machine and not a growth machine. So your focus when investing in ULTY or any other high-yield dividend funds is total return and payback period. Yes, the scars are there, and yes, net asset value erosion was real. But the post-March 2025 ULTY has a completely different profile, and so far it's holding up a lot stronger. So here's the bottom line. I think ULTY deserves to be judged on its new strategy, not just its old mistakes. But what about you? Do you think ULTY has really turned the corner, or are you still avoiding it because of the past? Drop your thoughts in the comments and let's talk about it. And that's it. And I will see you in the next video. If you like this video or any of the videos in my channel, please hit the like button and subscribe, and join me in my journey in generating my retirement income through trading options and investing in high-yield funds like yieldmax. If you have any comment or question about the no-loss method of the wheel strategy or my perspective about yieldmax, please write a comment and I will answer them the best I can. This is Mr. Chris. Thank you, and I will see you in my next video.